Same salary, same SIP, same market, same 20 years. One person builds serious wealth, the other is still wondering, I invested, so why didn't it work for me? Here is the uncomfortable truth. The difference between them isn't luck, it isn't stock picking skill, it isn't even how much money they put in. Most investors didn't lose money because market crashed, they lose money because they react exactly when it feels most logical. That moment feels smart, responsible, even disciplined. But that single reaction quietly kills compounding, the only thing that actually builds wealth. In the next few minutes, I'll show you exactly when this mistake happens, why almost everyone makes it, and how just by avoiding one behavior can completely change where you end up financially without doing more, risking more, or even investing more. From the time we start earning, we are taught one simple idea about money. If you want more wealth, you must do more. More income, bigger SIPs, more aggressive investing, more effort. But here's what nobody tells you. For most people, the problem is not how much they invest, it's how efficiently or how inefficiently their existing money is allowed to work. This video is about that inefficiency, the small, invisible mistakes that don't feel dangerous in that moment, but silently decides whether your money compounds fully or never gets the chance at all. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. Stay till the end because this only works when you understand how all the pieces fit together, and it's what stops people from undoing years of good investing with one emotional decision. Let's start with the biggest misunderstanding in investing. Most investors do not lose money because they choose bad investments. They lose money because they exit good investments at the worst possible time. This is how it usually plays out. You start investing with good intentions, you choose decent funds, you plan for the long term. Then market falls. Your portfolio turns red, headlines get dramatic, every conversation suddenly sounds pessimistic. And slowly, fear starts sounding like logic. Here's the dangerous part. You don't panic immediately. You check your returns. 1 year returns look bad. 3 years return don't look inspiring either. And then your brain starts quietly saying, maybe this isn't working. Maybe equity isn't for me. Maybe I should stop before it gets worse. This is the exact moment where most investors lose their future advantage because they are judging a long-term asset using a short-term emotional lens. Here's a line you'll need to remember. The market didn't steal your return, your reaction did. That reaction feels sensible, but it cuts off compounding right before it starts doing the heavy lifting. And this mistake almost always happens after you have done everything right. Equity isn't designed to look good every year. It's designed to work across complete market cycle, and the market cycles take time. Historically, in India, markets, a period of 5 to 10 years has almost always been enough for downturns to reverse and patient investors to be rewarded. Think about 2008, think about 2020. If you had invested just before these crash, your portfolio would have been down 30 to 50%. Exiting at that moment felt responsible, protective, even mature. But investors who stayed simply invested without adding extra money and without timing the recovery watched those losses slowly disappear. And then something important happened. They didn't just recover, they participated fully in the growth that followed. The ones who exited, they locked in the losses and re-entered later at a higher price with less confidence. That is how compounding quietly breaks, not in crashes but in reactions. But here's the part most people completely underestimate. Market moves in extremes, extreme fear, extreme optimism, neither lasts. What lasts is the average, the long-term growth driven by earnings, productivity, and economic expansion. That is why time in the market beats timing the market. Let me show you two investors. Investor A stayed invested through everything. Market crashes, corrections, scary headlines. He didn't react. He accepted volatility as a cost of long-term returns and let his investment compound year after year. Investor B tried to be clever. Every time market dips sharply, he exited. to protect his capital. When things recover and confidence return, he jumps back in, usually at higher prices. On paper, investors B's approach sounds smarter. In reality, it repeatedly resets compounding. Here's the data. Studies on both Indian and global markets show that investors who miss just few days or months of recovery end up with dramatically lower wealth, even though they took similar risks. Investor A benefits from every recovery, every compounding cycle, and every upturn. On the other hand, investor B keeps resetting his journey again and again. See, wealth in equity market is not built by avoiding volatility, it's built by staying present through it. Market rewards patience far more consistently than prediction. But here's where it gets interesting. Once you understand about staying invested, the next question is obvious. What actually turns an ordinary investment into an extraordinary result? The answer is not intelligence, it's not finding the perfect fund, it's not predicting the next multi-bagger, it's discipline. Most people massively underestimate how powerful and simple investing becomes when behavior is consistent. Take a modest SIP, say 10,000 rupees per month. On its own, it feels small, almost meaningless. But automate it, add 10% annual step up as income grows, let it run for 15 to 20 years. Historically, many well-managed equity funds in India have delivered 12 to 14% over long periods. At those levels, growth stops being linear, it becomes exponential. Here's the hidden advantage. Step-ups force you to invest across market phases. You buy more units when markets are low, fewer units when markets are expensive. No timing, no prediction, no emotional decisions. Over long period, investors who simply stay disciplined often end up with 2 to 2.5 times more wealth than those who invested irregularly or stopped midway. Not because they were smarter, but because they didn't interrupt compounding. What looks boring in the short term becomes extraordinary in the long term. If this is actually helping you think about investing differently, hit the like button and subscribe. It tells me that this kind of content is useful and keeps me motivated to make more of it for you. Now let's talk about the framework that protects all this discipline when life gets messy. Discipline is easy in theory, very hard in real life. This is where structure becomes powerful. Instead of treating all your money as one pool, the bucket approach separates it by time horizon. Bucket 1, short term, 1 to 3 years, right? These are for emergency needs, near-term expenses. You look at low risk, high liquidity instruments like savings account, liquid funds, short duration debt. Bucket 2 is for medium term, say 5 to 7 years. These are for education, home down payment, planned goals, etc. You look at balance equity and debt. Growth with manageable volatility is the objective here. And bucket 3, long term, 10 plus year or even 20 years. This is for retirement and wealth creation. Primarily equity designed to ride multiple market cycles. Here's why this actually works. When market falls, only one bucket bleeds, not your entire financial life. Because your short-term needs are protected, you are far less likely to touch the long-term investments during downturns. Let me show you with real numbers. Say a monthly surplus of 50,000, you invest 15,000 to short-term bucket, 15,000 in medium-term bucket, and 20,000 in long-term equity bucket. Now, these are just illustrative numbers. We need to plan this properly. Now, when market crashes, your lifestyle is safe, your goals are balanced, your long-term money gets time. The bucket approach doesn't increase returns, it protects behavior. And in long-term investing, behavior decides outcome. I have a detailed video on this 3-bucket strategy. You should get the link somewhere here. If you remember one thing from this video, remember this. Most investors don't fail because they start investing late. They fail because they stop too early. They don't lose wealth, they lose time. And compounding without time is completely useless. See, most investors lose money not because of bad investment, because they exit during temporary pain. Market extremes don't last, but patience allows averages to work. Discipline and automation quietly creates extraordinary outcomes. And structure protects your long-term wealth from emotional decisions. See, you don't need more money, you don't need to take more risk, you don't need better predictions. All you need is one identity shift. You're not the kind of investors who react to noise. You are the kind of investor who stays invested long enough for compounding to do its job. Two people, same starting point, same investment, one ends up with double the wealth. That single difference decides whether your money works partially or fully. That's how long-term wealth is actually built. Let me know your experience in the comments. Share this with someone who panics when market falls. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thanks for watching, and I'll see you in the next one.